Hey everyone. Last week I was talking to some investors who had a couple of very good questions. The first was, when will interest rates go back to normal? And the second, a related question, was whether the upcoming election in 2024 will influence the Fed's rate policy. A lot of people think that because there's an election next year, the Federal Reserve will lower rates. And of course, I can't definitively say what the Fed's policy will be in 2024, but I can tell you that historically speaking, interest rate movements during election years have not been measurably different from non-election years. Looking all the way back to 1955, the federal funds rate has gone up in election years 10 times by an average of about 135 basis points, and the overnight rate has gone down 7 times by an average of about 140 basis points. Naturally, some people may ask if there's a bias based on which party's in power at the time of the election. But I don't see any political bias driving rate decisions in election years. When the Democrats held the White House during an election year, the Federal Reserve increased rates 6 times and lowered rates twice. When the Republicans held the White House during an election year, the Federal Reserve raised rates 4 times and lowered them 5 times. I also didn't see any irregular rate movements in September or October of election years just before the vote. When I looked at the 10-year Treasury, which is far more important to commercial real estate lending rates and much more difficult to potentially manipulate, there was almost no difference between election years and non-election years. The average 10-year Treasury rate during election years was 5.63%, and during non-election years it was 5.68%. As far as movement in election years, the 10-year Treasury went up 8 times and it went down 9 times. With regard to the incumbent political party, when Republicans held the White House in an election year, rates went down 6 times and they went up 3 times. And when Democrats held the White House during an election year, the 10-year Treasury rates went down 3 times and went up 5 times. So I couldn't find any evidence of political bias affecting the 10-year Treasury rate during election years. Now, as for the other question, when will rates get back to normal? I think we have a bit of a generation gap in play. Investors who became active in real estate after the global financial crisis have been operating in a very unique interest rate climate. From 2009 to 2021, the average 10-year Treasury rate was 2.3%. Investors who were in the business between 2001 and 2008 were operating in a climate with a 4.4% average 10-year Treasury. Between 1993 and 2000, the average 10-year Treasury rate was 6.2%. Between 1986 and 1992, the average was 8.1%. From 1979 through 1985, the 10-year averaged 11.7%. And from 1969 through 1978, the average was 7.2%. So depending on when you got into the business, your definition of normal interest rates could be very different. The average 10-year Treasury over the long term is 5.6%, and today the 10-year Treasury is well below that, in the 4.25% range. In fact, prior to the second half of 2002, the last time the 10-year Treasury was at 4.25% was in 1965. So, from a historical perspective, the current interest rate climate is actually quite low. Yes, interest rates are higher than they were through much of the last 15 years, but since the financial crisis, the Fed has wanted to raise rates and create some dry powder to use in the event of a recession. So now that rates are a bit higher, I believe the Fed will try to stabilize at this level, which is about on par with where rates were in the early 2000s prior to the global financial crisis. That may become the new normal going forward. Of course, no one can predict what interest rates will do, as there are a lot of forces affecting rates. Assuming we are in the new normal, the commercial real estate market will take some time to recalibrate to the current interest rate climate. We're navigating the recalibration process right now, and cap rates have been migrating higher as investors adjust their expectations. However, I wouldn't expect cap rates to move up too dramatically because commercial real estate has become a more mainstream investment class that's drawing from a broader range of capital. As a result, the amount of money waiting for commercial real estate opportunities has grown significantly, and that wall of capital will restrain the upward movement of cap rates. Where cap rates ultimately stabilize will depend on the property type, the asset quality, the location, and a variety of other factors. But I do expect the market to find its footing pretty soon. We're already seeing the market navigate the price discovery process, and the expectation gap has begun to narrow. But as always, there are a lot of variables in play, which is why investors need to keep their eyes on the horizon.